Hello, this is Seewing Yee. Today's topic is a real estate master class. I'm going to dispel all the misconceptions, all the misleading information. I want to get everybody's emotional being out of the way. I'm going to provide you with conclusive data on the housing market. Let's take a deep dive. If you do enjoy it, at the end of this video, please smash the like button and subscribe to my channel. And if you're not a member of my real estate investment club, please subscribe your email so you can be a part of our free membership of our real estate network so you can receive free newsletters about real estate investing. Thank you so much. So without further ado, let's dive into some real hardcore data. Moving forward, there are many credible experts over the years, especially right now. They are saying we are a historical housing shortage. Some experts say we are at 6.8 million housing shortage. How did we get here? Why is this the case? And how is it going to affect our current situation moving forward in 2023 and beyond? So anyway, let's continue. Housing market, severe shortage from 1960 to 2000. We have 1 million, 61,000 average housing units built annually. And we needed 1.5 million. And then from 2021 to 2020, the average household units that was built annually was a little bit less than a million. And we needed 1.3 million. And then the projection from 2021 to 2031 for the next 10 years or so, we need 2.5 million units annually. This is very troubling. Forbes magazine stated that the housing shortage is worse than ever, and it will take decade of record construction to fix, new reports says. This article was dated June 2021. America is short more than 5 million homes, and builders cannot make up the difference. This is absolutely mind-boggling. We are short more or less 1.7 million homes, and we need 15.5% new homes built over the next 10 years. Because of household formation, there will be 11 million household formation, 500,000 new second homes. It all started back right after the great housing crash of 2008. From that period on, the builders, they have not been building new homes since the Great Recession back in 2009, 2010. So for the following decades or so and longer, as you can see, at the red color down here is at 5.8 million homes that are needed. Back then, before the recession, before the 28 housing crash, look at the inventory amount of construction. Then after that, look at the amazing decrease of new home construction. The 30-year mortgage rate, right now, we are the middle of February, we are at a 30-year fixed rate mortgage of approximately 6.6%. And as you know, back in 2021, we are at a historical low interest rate of 3% or even lower. If you look back in 1980s, the 30-year fixed rate mortgage rate around the early 1980s, a lot of you was not born at that time, so you have no clue what happened. I was around back then. I was a very young person at that time, but the mortgage rate were as high as 18%. I kid you not. I need to repeat, 18% mortgage interest rate back in the 1980s. Then it started going down gradually to a point where down here was around 2000. So the past 20 years, we have achieved a very, very low interest rate of around 4 to 5%. Americans have been spoiled in the past 20 years of very, very low mortgage rate. Even right now, 6.5%, give or take, interest rate is still, if you look at from a historical perspective, today's interest rate, mortgage rate is still very low. This is a reality. Now, in the past 9 months, as the interest rate has skyrocketed from around the second quarter of 2022, the mortgage rate increased around in the mid threes to gradually second quarter, third quarter, and fourth quarter 2022, the interest rate has skyrocketed all the way to as high as 7.3% back in October 2022. As a result, the new builders, they are very interest rate sensitive. Because of the higher interest rate, the new construction and builders have reduced their production of new homes. They have the permits submitted to build new homes has plunged. As you can see this graph. So the housing market continues to weaken due to stubbornly high construction costs and elevated interest rates, all harming housing affordability. If you could see this graph this past year from early part of 2022 until now, early part of 2023, single family permits has been down. The builder confidence level has dramatically decreased, and they are trying to sell off their remaining excess inventory as we speak. And then moving forward with this, construction has been decreased dramatically this past year. It will have a very long-term effect. It's going to affect the supply of inventory of homes, not just this year, but for 3 years to come. So, and then the current homeowners, by the way, U.S. homeowners equity surged to over 27 trillion with a T, as the value of homes of the housing stock has surpassed 39 trillion. This is mind-boggling. So most people, their largest asset is on their home, the home that they own. As you can see, the mortgage debt in relationship to the equity of their homes is a big gap. So this means the loan to debt value is very low. So people that have purchased homes and rental properties for in the past, they were sitting on a massive gold mine. The key to wealth building, most people make their money on a historical basis through real estate. Always has been, always will be. So for those of you sitting on the sideline, you're making a big mistake. Assuming you qualify to buy a home these days. So it's all about economics 101, supply and demand. If demand is greater than supply, you're going to have a very healthy housing market. And we are at the demand, believe it or not, the demand is greater than supply, even as we speak. Sellers are locked in. 9 out of 10 mortgages have an interest rate of less than 5%. This is mind-boggling. More than 40% of all the homeowners don't even have a mortgage, debt-free. So homeowners are locked in. They're not going anywhere. And that, in addition to home builders not constructing, is already have created a extremely low supply inventory, not just 2023 this year, but in my mind, for down the road, a number of years to come. Look at the further breakdown. 65% of people that have mortgages these days have an interest rate of 4% or lower. Not only that, look at this. 11 million people in the country have mortgage 30-year fixed rate of 3.5%. 13 million have interest rate less than 3%. 4.7 million people have interest rate less than 2.5%. Those people, they have very little motivation to sell their homes. Why would they upgrade from a 3% home to a 6.5% home? There's simply they're not, they can sit on that massive amount of equity. They can sit on their mortgage rate for a long, long time to come. So it's very, very hard to entice the current homeowners to get rid of their mortgages. Moving forward to right now, per the Altos research, single family homes, as you can see on this graph, currently in January 2023, we are at less than 500,000 homes available for sale. Recently, the past month or so, the inventory supply has been decreasing. Back in 2015, 8 years ago, there were approximately 2 million homes available for sale. So this up and down is consists of an annual seasonality of it. The last quarter of every year, is always uh, less activities. But the beginning of the year, uh, similar to what's going on right now, the first quarter of 2023, we have seen a lot of uptick in transactions and people getting off the sideline. Needless to say, at less than 500,000, we are like 200% less amount of supply inventory than we need to meet the demand. And especially when the mortgage rate continue to slightly go down, you're going to see a pent up demand, and it'll flip the housing market very much back to a seller's market, very much back into a housing frenzy, potentially, in my mind. We'll see. Only time will tell. Now, the job report has recently was published a couple of weeks ago, showing an increase of 510,000 jobs, crushing the estimates. As unemployment rate hit 53-year low. Right now, it's hitting at 3.5%. For any type of situation, a crisis to occur, I mean, for a recession, or for foreclosures, or for anything that has to occur, you need a job unemployment rate at least 5% or more in order to have an impact. Right now, the economy is still very strong. The job availability opportunity is still very strong, and unemployment at a 53% mortgage rate. So, now if you are predicting for doom and gloom, well, you could be on the wrong end of your prediction. Now, some of you think the recession is going to have an impact on the housing market. Well, let's look at the data. And we might be even going into a recession already. No one really for sure knows. But housing is very resilient. Housing stays strong through recessions. The S&P Case-Shiller U.S. National Housing Price Index, as you can see, this black line over the past a number of decades shows recessions time frame. The white line shows the index of housing, the National Housing Price Index. The housing continuing to consistently keep on going, with the exception of the 2008 housing crash, right? That's the only anomaly. Otherwise, other than that, we have seen some steady home market increase even through all the recessions in the past 40, 50, 60 years. So recession does not equal a housing downturn, housing crash, whatever. Home price change during the last recession, look at 1980. Still very strong, 6.1% growth. 1981, 3.5%. 1991 was only down temporarily for almost less than 2%. 2001, slight recession. Housing prices still doing well. Only the housing crash, 2008, was a once in a lifetime occurrence, other than the year 1929, I believe, the stock market crash. Really, you can make the argument in the past 100 years, there has been only true great housing crash dash economy crash, housing recession crash. And of course, right now, we are going through a short-term recession. The past 9 months, I guess, from May of 2022 until now, we're going through maybe a housing correction around 10% nationwide. I mean, national housing market, if you will, although there's no such thing as a national housing market. Housing market is very, very hyper local. Every specific market and region are different than from another market. All right. So moving forward, existing home supply. So again, no one have a crystal ball, but I have given you some amazing data, some conclusive data, I believe. So recently, a few weeks ago, December, nationwide, we have approximately 2.9 months supply of inventory, which is very low. 4 to 6 monthly supply is a balanced market. We are far from it. Okay. And the mortgage rate, many credible experts out there, many resources out there have stated that the mortgage rate is on this downward trend because the inflation is being attacked, is being monitored. The Federal Reserve will continue to look into the inflation to stabilize the interest rate. And as we have seen some inflation subsiding little by little, and as a result, the mortgage rates potentially will go down. That's what we're hoping for. So buyer sentiment improved slightly in December, and we're seeing some very good trends. I personally have seen many local markets that we are involved in. We've seen a lot of activities. We're seeing a little bit of bidding wars. So, so that's what's happening. All right. So that's my takeaway in that clearly, based on the data, economics 101, when a pent up demand is greater than limited supply, you know, the housing market is going to be very, very healthy. So absent any catastrophic events, the year 23 is shaping out to be a very, very robust market. And I've seen a lot of activities. People getting off the sideline, even at a 6% mortgage rate. I think people are really, they were shocked at the psychological effects of the sudden rising of interest rate back in the middle of 2022. Now I believe the people who can afford it, they have a lot of motivation to buy in this very, very low inventory market. So there's a lot of pent-up demand, especially if the mortgage rate or projected to go below 6%. Who knows? If the mortgage rate go around is between 5 and 6%, the mortgage rate, the year 2023, we will see a lot of housing market frenzy. So, so in my mind, the housing market is trending in a very, very positive way. So if you as a primary home buyer out there anywhere in the country, if you have the means to, if you qualify, I know it's not that simple. If you qualify to buy a home, if you have a long-term buy and hold strategy, 7 to 10 years or more, if you have a good finances, you have a good stable job, who's to argue that you shouldn't buy a home? Because over time, the real estate will always increase in value. So you have this for real estate investors right now. I'm in a real estate investing space. That's what we do for the past several decades. And I encourage our investors to start pulling the trigger as long as you find the right market, affordable market, and whereby the rent will cover your debt service. You do a 25% down payment typically to buy single family home rental property. You can cash flow. You're good to go. Invest for the long term and take advantage of a lot of the great uptick in activities going on. So hopefully this video will help you educate and get be better informed instead of going listening to all those doom and gloom YouTubers out there. They're providing a lot of information, a lot of inaccurate, misleading information for the sake of clickbait. And so negative headlines out there just very, very paralyzing. So if you receive a lot of value from this video, please smash your like button and subscribe to our channel, and also subscribe to my email on the website below. You can become a free member of our real estate investing community so you can learn how to become a great turnkey real estate investor. Thank you so much. This is Seewing Yee. Thanks for listening. Have a nice day. I'll see you on the next video. Bye-bye.